More and more small business owners are going broke, and the sad news is they don't even know it. In this video, I'm going to ask you 3 simple questions that are going to help you figure out if you're on that path to going broke and tell you and show you what you can do about it. So the first question, and maybe the most important question because it affects the other 2, is what is the most important financial statement? Now, most of you are going to want to say the P&L, the profit and loss, because that's where you see revenue and expenses and profit. But that's the incorrect answer. The correct answer is your balance sheet. The balance sheet is what shows you the assets, liabilities, and equity of your business. Equity is the difference between assets and liabilities. Now, why is it the most important financial statement? A couple reasons. Number 1, if your balance sheet is wrong, then your P&L is almost always wrong. Why is that the case? Well, the P&L is an output. It's a function of the balance sheet. And so we have to make sure that those numbers on the balance sheet are accurate, complete, that they're representationally faithful, that we have the right timing, and that we're truly presenting all the assets and liabilities of our business. What I just described there, those 5 things are called the 5 financial statement assertions. We need to be able to check all those boxes for every item on our balance sheet. Now, 9 out of 10 times, or maybe more accurately, 99 out of 100 times, I'm going to look at someone's balance sheet, someone's small business owner balance sheet, and I'm going to see negative assets or negative liabilities. Now, a negative asset implies that you owe somebody money. Now, a lot of times I'll see negative balance with a Chase account, negative $200,000. That implies that you owe Chase $200,000. But that couldn't possibly be true. They wouldn't let you be that overdrawn. Or I see a negative Capital One credit card or American Express balance, which implies that the credit card company owes you money. Almost always not the case. Or I see negative payroll liabilities, as if your employees would somehow owe you money back. And so when we reconcile these balance sheet figures and get them accurate, complete, with the right presentation, the numbers in the right period, day, month, quarter, and we've confirmed they're actually your assets and liabilities, then that changes the profit and loss statement. And all of a sudden clients have this, small business owners have this aha moment and go, oh, now that I see that my profit number is significantly lower, now I understand why I'm having cash flow problems. It starts with the balance sheet. That's the most important financial statement. Now that you know that the balance sheet is the most important financial statement, I have my next question. What is the most important thing you want to be looking at on your balance sheet? Cash is important. Liabilities are important. But what we really want to see is that equity number at the bottom going up. That means that our assets are growing at a faster rate than our liabilities. We really want to see that because the end game is to grow the net worth of our business. While the value of our company could go up, we've grown our revenues, and so the valuation number is higher. If our net worth number is going down, that means we're taking on more liabilities. Then we sell the business. When we pay off all those liabilities, we may end up in a worse off position, meaning even though revenues have gone up month after month, and that's grown the top line value, the walkaway number, the amount that we actually get, is less. So growing a business just purely focused on revenue is clearly problematic. The end game is to grow our net worth. Why do we want to grow our net worth? Because that's how we fund our retirement, or fund what I would call our solvable problem, your unique definition of wealth. Your business, your assets, they all exist in serving you towards living the life that you want. That means we got to grow our net worth to fund that life that we want. And I can give you so much evidence to show you that how often a business owner is growing and they're in the worst position they've ever been in because their liabilities increased faster than their assets. One way that you can measure that is through my next question. What is a ratio that you want to look at month after month? And there are multiple ratios that might come to mind, but what I'm going to tell you in the vein of talking about growing your net worth is something called the current ratio. Now, the current ratio is a way of measuring the liquidity of your business. How easily are you going to be able to pay current expenses and current debts? And so the way that we calculate this is we take current assets divided by current liabilities, and that output is called the current ratio, and it's showing us how liquid we are. Now, you might be wondering, what is a current asset? And a current asset is cash, cash equivalents, and any other asset that we can readily convert to cash in the next 12 months. Current liabilities are any short-term debts that need to be paid within the next 12 months. Credit cards are going to be an example of that. Accounts payable might be an example of that. And so we need to make sure that we have an accounting as well, again, of all of our current assets and current liabilities. A lot of times businesses don't have all their current liabilities accounted for. What's an example of that? Something called unearned revenue. So when someone prepays you for services or they pay for a year in advance, that's not revenue. Although if you're on a cash basis, the way you might report it is revenue, but you still have a liability because you still have to fulfill on that over the next 12 months. And so a portion of that payment is a liability because you still have to fulfill on the service and there's a chance that they're going to refund it. So a lot of times businesses have an unaccounted for liability that sneaks up on them later. So in calculating this ratio, current assets to current liabilities, we have to make sure we have accounted for all of these liabilities. Now the target for our current ratio, current assets divided by current liabilities, is 2 or greater, which means we have 2 times the current assets to our current liabilities. Now more than that is great because that means that we are contributing to growing our net worth. So to summarize, the most important financial statement is the balance sheet, not the profit and loss. If the balance sheet is wrong, the profit and loss is wrong. And then what we need to be focusing in on when we're looking at the balance sheet is, are we growing our equity? Which is another version of thinking about the net worth of the business. So revenue is great, profit is great, but in order to get there, we're growing our debts and our net equity is going down. We have a problem we need to solve right away. And part of the way that we're going to tease that out is through the last step. We're going to look at our current ratio, current assets divided by current liabilities. We want to see that greater than 2. If you can say yes to doing all these things, then you're on the path. You're in the 18 percentage point or higher small business. What do I mean by that? 82% of small business owners are going to fail because of cash flow problems. You're going to be in the 18%. You're not going to fail because you're looking at the right financial statements with the right approach, because the biggest risk in life is not living the life that you want. This business needs to serve us in funding that life. Real quick, if you're watching this video and you're thinking, Dan, how could you be my CPA and we could do this all together? Well, go down to the pin link below, or the description below, click on the first link. That's going to take you to my website where you can schedule a quick call and see if it makes sense to work together. Now let's get back to the video.